Welcome to Crypto Clarified, Investing in the Truth, a podcast series where we come together each month to discuss the most captivating headlines and trends from the investing in crypto space. My name's Benjamin Dean, I'm Director in WisdomTree's Digital Assets team, and I'm joined by my co-host, Camilla Russo, who's founder of Defiant Media. We're also joined this week by our special guest, Ed Fricker, an attorney licensed in New York State who represents predominantly clients in the startup, cybersecurity, and crypto fintech sectors. Cami, how are you?
I'm great, Ben. It's great to see you again.
How has your last month been? It's been busy, right?
It's been insane. In the news business covering crypto, we've just been flooded with just breaking story after breaking story. So it's been really fascinating. I think we're living through historic times right now in crypto.
Absolutely. It's never a dull moment in the space. And this month, we've got a lot of crypto to clarify. It's a great thing that nobody loves clarifying crypto more than us. But we're going to have a very special guest, Ed Fricker. Ed, welcome.
Hello, thank you very much for having me on as well.
So before, Ed, I ask you to introduce yourself, I will say that we always love questions coming in. So please send them over, cryptoclarified@wisdomtree.com, or ping us on Twitter. You can find me at Benjamin Dean, Cami at Cami Russo, and you could even reach out to Jason at Guthrie if you feel inclined to do so. Before I begin, though, I do need to state the following. So shout out to James and Sam in compliance. To clarify, the views and opinions expressed in this podcast are those of WisdomTree and Defiant Media and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information presented is not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon it is at the sole discretion of the listener. Information we present may be based on back-tested or forecasted data. Please remember, past performance is no indication of future results. With the housekeeping done, let's kick things off. Ed, tell us a bit about yourself. So my understanding is that you and Cami already know one another, which is fantastic. But the listeners don't know who you are. So give us a brief synopsis about you, the work you do, and how you're involved in the crypto space.
Sure. So I am a New York attorney. My name is Edward Fricker. I've been working in the cryptography and tech startup space for the last 8 years or so. Of course, back then, the cryptocurrency space was very nascent and small, and it's progressively grown since then. So I've been an advocate for founders in the cybersecurity and cryptography sectors. I've been representing them on, for things like venture capital investments, token sales. I've also been helping a lot of investors, venture capital investors, angel investors, and hedge funds with their move into the crypto space. And yeah, being quite busy in advising that area. I first spoke to Cami when I co-founded a conference called DeFiCon, which is a New York charity conference to raise money for local charities in New York. And Cami was a fantastic partner to that event. And the conference is happening again in just a few weeks in New York City. So everyone's welcome.
Excellent. Well, thank you for joining us today. Very timely to have a legal perspective given the events of the past month or so. Cami, you can't avoid this Three Arrows Capital, right? If anyone wants to get full updates, you go to the defiant.io. It's all there. But Cami, if you could give us like the synopsis, what's happened? What is Three Arrows Capital and what has been unfolding in this space the last month or so?
Yeah, so Three Arrows Capital grew to become one of the most, relevant, looked after kind of and biggest funds in the crypto space in this past bull run. Reportedly, it had around 10 billion in assets under management. And it invested all over DeFi, all over crypto. and it had very vocal founders, Susu and Kyle Davis. Sue had coined this concept of the super cycle, which said that basically crypto prices would continue going up and up, and we wouldn't have like a huge drawdown like we had seen previously in crypto. And it turns out that Three Arrows had, based on this thesis of the super cycle, they had gone massively long on crypto with leverage. So they had taken on leverage loans with different lenders and counterparties across the space. They had also taken on own portfolio companies, funds reportedly, and manage their treasuries. And obviously, they had taken on external capital to invest. Other funds had trusted, their assets with them to invest, and so they were this piece in crypto that had become connected with all these other different entities. And so when when the crash started to unravel, and particularly there were a few positions that they were in that didn't play out. One was the Grayscale's GBTC trade, which it's this trust that holds Bitcoin, but it's not an ETF, so it doesn't have daily redemptions, and it's only kind of it's traded in a way that usually it did trade at a premium to the Bitcoin price, like the trust price was at a premium to Bitcoin. So that used to be a really good trade for investors who could get in and buy it at the NAV price. But then that trade started to fall apart, and now GBTC is actually trading at a discount to the Bitcoin price. So Three Arrows was in that trade. They also held staked ETH, which is a derivative of Ether in the proof of stake chain issued by Lido, and that used to trade at 1-to-1 to ETH, but now it started to trade at a discount again, and those were kind of the main two, and of course Luna that was the other trade that Three Arrows was big in, and that of course failed spectacularly, as we discussed last time. So there were like these big trades that many investors were kind of, it was like very popular trades that just unraveled very quickly, and Three Arrows happened to be in all of them in a big way, and so that just had this cascading effect where it all these trades collapsed, and now it wasn't able to pay back loans and meet its collateral requirements with places like Celsius, like Voyager, which went bankrupt because of it had I think lended hundreds of millions of dollars to Three Arrows Capital. I think it was like 600 million or something like that. So it went bankrupt. Babel Capital also had was under a huge strain because of Three Arrows exposure, and so on. So it's just been a huge mess. Like it's had this incredible just domino effect on the whole space.
Absolutely. The systemic risk is noticeable, and as you say, it's almost like dominoes falling. Three Arrows Capital, a hedge fund with leveraged long positions, wrote a market note this month. LTCM without the Nobel economists is the title. And that's me trying to be wry, but This has not been unseen before in traditional finance. But what is kind of interesting, though, Ed, is seeing bankruptcies and insolvencies in the space now. The size of them is noticeable, but this is not the first time that we've seen these kinds of events in the crypto space. Give us a short history then of what we've seen in the past and how it compares to what we're seeing play out right now.
Yeah, and it's very interesting when you do have a bubble burst or a crash, because you get a lot of legal action as a result, and these uh, in the end serve to clarify what how people should act in the future, because you get lawyers and judges making rulings about how things should be treated, so that when the next problems happen, they're not as serious. So obviously the first big bankruptcy that most people talk about was when in 2014, when there was a big Bitcoin crash and China banned Bitcoin, and Mount Gox was hacked. At the time, Mount Gox was the only highly liquid centralized exchange, and it was considered the oracle for Bitcoin pricing. But yeah, it went bankrupt in Japan, and this resulted in a lot of international legal negotiations, for people hearing about Bitcoin for the first time, and Japanese government and lawyers who'd never had to really look at this before, treating this with very very serious purview, and passing laws and crypto regulations and this kind of thing. As a result, we can see Japan is probably the clearest crypto legislation in the world, because they understand the results of not having this kind of clarity. 2014, then we had several other sort of bankruptcies, usually as a result of quote unquote hacks. Sometimes the hacks were just the team themselves being compromised, or someone leaving with the money. But with the crash of 2018, 2019, we saw exchanges like Cryptopia. Cryptopia went bankrupt. As a result, we had the first major lawsuit that determined that Bitcoin was legally property. It wasn't some kind of immaterial value thing. It wasn't some kind of it wasn't just data. It was actually property that could be held in trust by other people. Now, what's really important to note is that that same lawsuit, which was resolved by the New Zealand High Court in 2020, using pieces of law from the United States and UK as precedent, was that cryptocurrencies can be held on trust by a centralized holder. They're not just property that goes back to the creditors. So if you are owed money by a centralized custodian or investment manager or exchange, which are essentially the same business model, you are having your crypto, according to this judgment, you have your crypto in trust with that particular custodian. So that money has to go back to you and not to the people that that company owes money to, which is very interesting because, let's say an exchange does go bankrupt because it owes, a big FTX or even 3 Hours Capital a large amount of money, then your crypto accounts are still safe. This was important in Cryptopia because a lot of Bitcoin and was taken. As a result, the exchange went bankrupt. But if you held a lot of Dogecoin or other cryptocurrencies there, your accounts were safe. So people that held Bitcoin, the one that was stolen, they were the ones that missed out, which is very informative for people in the future. There was quite a lot of discussion with regards to the potential bankruptcy, if it would ever happen, of an exchange like Coinbase, where there was a letter to creditors that said, we decide to treat accounts as part of our balance sheet and not, in trust to the account holders. I don't. It would be very interesting to see how that would actually hold up in court, because we do have a very strong decision on the Cryptopia case. At the moment, you'll see I'm wearing a hat that says HODL. This is actually a Celsius hat that I wore just for this particular chat, because I thought it was relevant. Celsius have chosen to force people into HODL mode, so they can't withdraw their own currencies from the platform. This is sort of interesting, if they would be allowed to do that. Given their particular regulation and their local authority, they might not be able to treat customer funds as sort of lendable and investable on their own balance sheet. But this is a really important question that anyone who lends, anyone who invests in a company, and anyone who puts their money into an account in a particular exchange or investment service needs to think about. If there is trouble with the company, do I still get my money back?
Now, you've just jumped 3 steps ahead of the folks listening there, Ed, which is a good thing. But we need to rewind a little bit here. So as a quick summary, what we used to see in the past was exchanges going bust. People would deposit their cryptocurrency, in inverted commas, in an exchange. And for a variety of reasons, these exchanges would go bust. Now, Cami, you mentioned Celsius and Voyager as well. What kind are those exchanges? And if they're not, what is it that's different about what they were doing compared to the defunct businesses we've seen in the crypto space in the past?
Yeah, so I think while we've seen bankruptcies in crypto before, I think what's different in this crash is that the space has become a lot more complex and sophisticated and interconnected. So while before kind of the main, biggest businesses in crypto were basically just exchanges, now we have other financial services, and lenders have become an important part of the system, both in CeFi, in centralized crypto, and in DeFi, in decentralized finance. And so Voyager and Celsius were both centralized lenders. So that means that they took customer funds in custody and offered this lending and borrowing service. And what's different here is that before, exchanges were hacked and went bust, but now it's about this systemic risk, right? It's about Celsius lending out customer funds, or I should say, not just lending out customer funds, which that's their business, but it's investing customer funds in illiquid strategies, and that's where it ran into trouble. So Celsius was offering close to 20% interest rates on customer deposits, and the way it was able to offer those returns was by using Anchor, by using Terra's now defunct lending protocol. So it was taking on massive risk with customer funds, and it wasn't disclosing exactly what it was doing with those funds. So it was acting like a hedge fund, like it was investing deposits, which people thought were, they were safe in Celsius hands, but no, they were going off and doing very risky things with those deposits. And so what happened is, because the system is interconnected now, and all these applications and projects are plugged into each other, Luna went bust, and that kind of affected Celsius. 3 Arrows went bust, and because it had taken out loans with Celsius, that affected Celsius, and so on. Same with Voyager. So
yeah, it's like it strikes me as a cybersecurity person, or at least in my life before Wisdom Tree, I worked in cybersecurity. And a lot of those exchanges back in the day used to go bust because they kept the keys, the private keys, on hot wallets, so connected to the internet. So it was a cybersecurity or operational set of problems. But what we're seeing play out here is something that looks a lot more like traditional finance.
Yeah.
This is debt going bad, leveraged long positions without sufficient risk management practices in place. Ed, earlier when you were describing the space, you were saying that eventually in the past we've seen as these kinds of blowups happen, that laws and regulations end up being updated and changed. Do you have any view on what the likely fallout will be in this iteration, especially given that now kind of the new problem has been irresponsible crypto lending, which didn't used to happen?
Yeah, I think it's actually very promising because as a result of the Mt. Gox hack and collapse, you had to have um, because the legal system in Japan is extremely slow. No, even people still don't have their Bitcoin back. It's been 8 years, right? So what they had to do, all of the creditors had to get together, and so they would actually receive their Bitcoin back that they had in their accounts, or the fraction that was still left. Uh, they had to agree to a settlement that would sort of benefit like all of the creditors as a whole, right? And I think this kind of collaboration between people that have usually never met each other in real life. It's a very scattered and I would say dysfunctional community because it doesn't function as a community. This is going to change, right? We're going to see lenders suddenly think, oh, why didn't I ask my friends who I talk to all the time if they've also lent several $billion to 3 Hours Capital? Why, here are all my friends that I should be talking to more regularly to get a better sense as to how big are the liabilities of this company I'm dealing with. That people just weren't asking those questions and they weren't collaborating as much, right? So I think with the firms that do survive this this crash and the resulting uh, insolvencies, we'll see generally what's called restructuring. That's when generally a banker or a very successful finance person will go and talk to all of the creditors and say, hey, you know, um, maybe we can still make good on some of the money that you're owed, but it will be like a more extended process, or some other kind of way to pay you back, and then in negotiation with a group of people who are owed money, come up with a sort of final settlement, a restructuring sort of situation where people might swap, some of their debt for ownership in the new survival company that gets created. So this could happen and probably will happen with some of the larger entities. So as a result, you'll have more cohesion between the different surviving companies in this space, and a greater sense of collaboration between the different professionals in the crypto space. Even though that might have taken quite a bit of a hit in the last few weeks.
It's going to be a nice segue, Ed, into the second half of this episode, because what we are seeing is this consolidation happening across the industry. Cami, consolidation across the industry, that doesn't sound hugely DeFi, but I'm wondering if you're watching what's going on here. I'm thinking about folks like Sam Bankman-Fried, FTX, or Binance. Are you also seeing this consolidation in what we call DeFi, but is looking less and less decentralized by the month?
I think we'll talk about that more coming up, but things like Celsius, Voyager, 3 Arrows Capital, that's definitely not DeFi, and I think and like a separate point is consolidation, which I think we will see both in CeFi and DeFi. and it's just a normal process to happen in downturns. Some businesses become insolvent or get into trouble, and then other businesses with stronger balance sheets take that as an opportunity to scoop up those discounted assets. It's just normal capitalism at work, basically. So I think we'll see this happen across crypto. I think it'll look different in DeFi and CeFi. In DeFi, maybe it'll be kind of DAOs consolidating, or who knows. In CeFi, what we've seen is Sam Bankman-Fried and FTX really taking this opportunity to come in and gain just like massive positions all over the space, and they've become this sort of I don't know, like bailout system or something. But it's unclear to me exactly what the driver is. So you can kind of be very naive and simplistic about it and say, like SBF is a very kind of shrewd business person, and yeah, he's seeing the opportunity to buy these assets at a low price. Like he has this option to buy BlockFi at, I think, 240 million or so, after BlockFi was valued at over $1 billion. Like it was a unicorn at some point. So now he's able to grab that at a huge discount. Same with Celsius. He's offered a revolving kind of credit line, I believe. So he's just like taking these opportunities. But I've read this more kind of cynic take where SBF is also very much on the line with these entities. Like it's unclear exactly how much SBF's entities like FTX, Alameda, how much they've borrowed, and how much they rely on all these lenders to remain solvent. So it's also maybe maybe it's opportunistic, but also it's they're doing it in a bit to just like save themselves as well. That's just like speculation. I've read just something to think about. But I think we're starting to see this consolidation, and it's coming from huge players like FTX, and who have like very, very strong balance sheets and are able to take advantage of this time.
Yeah,
I really
absolutely.
like what you just said, Cami, especially about the difference between DeFi and CeFi, right? And yeah, as you noted, some people don't really know the difference between DeFi and CeFi because they go to a website and they just see the logo and the branding, and they don't know the right questions to ask. How decentralized is this? Why is DeFi better than CeFi? Uh, and I think we've proven over the last few weeks that if you do have a DeFi system where there is no single person in control and no one can take your assets and do things that you didn't give permission for, then you are safe from these kind of collapses. So it'd be really interesting. So actually, maybe I could ask you this question: like, what if you were asked by somebody, Camilla, how do I know if something's decentralized or not? Like, what would you recommend they ask, and what kind of research would you recommend someone do?
I think like the main indication of whether something an entity is centralized or decentralized is whether it's non-custodial or not. Like, are you in control of your private keys or not? And that's pretty binary. With Celsius, you are trusting a third party to take control over your funds. You don't have control over your private keys. When you're using DeFi lending protocols like Aave and Compound, you're not trusting a third party to keep custody of your funds. You have the custody of your funds. You have control over your private keys. And then the second step is who is making these like transaction decisions. When you're interacting with a DeFi lending protocol, all these decisions of lending, liquidations, everything is done by a smart contract. There's no kind of, centralized human making arbitrary decisions on what to do with your funds once they're in the protocol. It's a smart contract. So, and you're interacting directly with it. And so that gives that provides a lot of guarantees that someone's not going to take off with your money and use it in all these kind of risky places that you have no idea what's happening, like it happened in Celsius. When you're using Aave, you know exactly where your funds are because everything is transparent. It's on chain. You can track it, and because you have control over your funds, you're able to withdraw them from the protocol whenever you like. Like there's no freezing withdrawals if the protocol is properly decentralized. So those are the things to watch out for. I think the clearest sign is whether it's custodial or not. And then whether it's, who's making those transactions. Like, is it a human or is it all automated on chain?
Yeah, I guess if
Indeed.
you have to sign up or put in your email address or name, that's a good proof that it's not DeFi, right?
Yeah.
Indeed. A very succinct description of what DeFi is characterized by. Ed, we've come up on the half hour, I'm afraid. It's been a pleasure having you here. We hope to have you again another day.
It's been great. Yeah, thanks so much. And yeah, I look forward to watching the rest of this. After DeFiCon.
Excellent. Yes, indeed. DeFiCon. What's the website that people can find for DeFiCon?
DeFiCon.nyc. So DeFicon.nyc. All of the tickets are NFTs that you can mint, and all of the money goes directly to the charities. None of the founding team take any salaries or anything. It's a true non-profit.
Excellent. Well, thanks again, Ed. It's been a pleasure. Thank you for listening to part 1 of our latest Crypto Clarified podcast. Stay tuned for part 2, in which we'll be tackling key educational topics, as well as debunking some of the popular misconceptions around cryptocurrencies in our Crypto Myth Buster session.